Fox Business. Well, New York Senator and presidential candidate Hillary Clinton talking about her stimulus ideas right here on this network just a little while ago. She says she wants to put cash in the hands of Americans struggling to pay their bills. Listen up.
We've got a weak housing market. We've lost 6% of housing wealth in the last year, 12% here in Nevada, which is leading the country in home foreclosures. The $30 billion fund would be an adjunct to the moratorium and the freeze. But I also have $25 billion going directly into the hands of Americans who are having trouble paying their energy costs. What I've proposed does put $650 into the hands of millions of Americans to deal with their energy costs, tries to save people's homes from being foreclosed on, and give communities some help.
So is that the right way to get the economy moving? Our own Elizabeth McDonald joins us along with Mike Norman of the Economic Contrarian Update, and Yaron Brook from the Ayn Rand Institute, and Peter Schiff, author of Crash Proof. So Yaron, let me go to you first because you wrote something about stimulus packages that I was reading, suggesting that the economy needs to be liberated, not stimulated. Explain.
Yeah, what we need is not some short-term solution. We don't need these short-term tax breaks that we're going to have to pay for later. We don't need checks sent to consumers. What we need is the cause of these economic problems to go away. And the cause has always been government intervention, government spending, government regulation. I would love to see somebody propose repealing Sarbanes-Oxley as one way to stimulate this economy. What we need is more business activity, more job creation, get the government out of the way and let businesses do their job of making money, creating jobs, creating wealth. That's what a healthy economy needs.
So Elizabeth, which would you take? Euron's solution or Hillary's?
I would take Euron's, and I would also
and you
argue,
like Hillary,
and I think that Hillary has been pretty strong and very not assertive in coming out with a fiscal stimulus plan of her own. I think that's courageous to do that right now. What I would do is cut corporate taxes, because let's face it, companies never pay corporate taxes. Investors and
let me just stop you right there. How do they avoid?
They basically pass it along to customers. They pass it along to investors. But academics are now saying more than those groups. Workers get it in the neck. It's probably behind the reason why you see stagnant wage growth. And what's striking to me is that in the fiscal stimulus plans, you see the deficit hawks getting trampled. I think Aaron is absolutely right. The guardrails are off when it comes to spending. We spend $400 billion annually on our $9 trillion deficit alone. That's north of the GDP of Saudi Arabia. So, he's right about shrinking regulation,
okay.
Although I do think Wall Street needs some
along.
Mike,
more even Democrats, I'm thinking of Charlie Rangel in particular, the chairman of the House Ways and Means Committee, said that perhaps they could agree on some kind of lowering of corporate tax. Would that be a good stimulus?
Yeah, I think it would be a good stimulus. Look, I don't even know we need a stimulus at this point, to be honest with you, because
really?
You just talked about the fact, and I think it's correct to point out that what the Fed said from the Beige Book
That's
is
true.
that, and it's highly anticipated that fourth quarter will be a negative number on GDP. It's probably coming in 1.5, depending on exports. It could be revised up to 2. We might not be in bad shape. We just saw mortgage applications jump to a 5-month high in the recent survey. Okay, mortgage, interest rates now down to a very low level. Very little housing being created, new housing now, 1 million new homes with a 300 million population.
All right, well, Peter, Mike, your friend Mike Norman brings up a very good point. Perhaps a stimulus plan, at least the ones where you pay out these rebates, have never worked particularly well in the past. We had one in 1974 with President Ford. We had one in 2001 with President Bush. As of 2003, that rebate didn't work, and the one in 74 didn't work, so why should one work now?
Well, it's not. I mean, I might agree with Mike, but for the wrong reasons or different reasons. I think we're going to be in a recession. I think we're already in a recession. But I think the last thing we need is the government to stimulate more consumption. The reason we're in this mess in the first place is because we already had too many of these stimulus packages that got Americans borrowing and spending money they didn't have. What we need to do is start saving money. Hillary says we got to put more money in people's pockets to spend it. No, we don't. They need to find a way to spend less, to make a budget, to give up things that they don't need. We need to start saving. Sure, we're going to have a recession. We can't do anything about that. That's the price we pay for all this excess consumption of the past.
We save more than any country in the world.
We don't.
Wait a second. We have a $57 trillion positive net worth, which is...
But that's asset inflation.
No, that's not asset inflation. It's our assets minus our liabilities. Look, the assets that we own as a nation is the accounting record of our savings. And
Mike,
by the way,
if we had all those savings, it wouldn't be the Arabs and
hold on, Peter. Hold on, Peter. Go ahead. Finish your point.
Even that monthly number that we see the from the Bureau of Economic Analysis of personal income minus personal outlays. That has recently turned positive. It's been positive for a year, so this is flat out.
Mikey, just proved my point when you said it is assets minus liabilities. But let's move on. Mario Gabelli said it right, and I agree with Peter that the consumers went over the cliff without even tapping the brake. He is absolutely right, and I have to say the Fed should have seen that the economy is slowing down. November 2001, it held interest rates too low for 3 years. That helped consumers on this, this spending binge. And like alcoholics, we are now dealing with.
Well, hold on a second. Hold on. Let me bring in another element. Yaron, today we have an announcement. Well, it's going to come out on Sunday in the New York Times Magazine. This interview with among other people, Paul Volcker, who was Fed chairman, who said that yes, there were all of these bubbles, not only the housing bubble that was created with these low interest rates, but then the dot-com bubble, etc., suggesting that Mr. Greenspan has a lot to answer for. What do you say?
Well, I think the Federal Reserve has a lot to answer for. I mean, go back to the recession, to the 1987 crash and the recession in the early 90s and the internet bubble. These are all caused by Fed policy, by missing on interest rates, either too low or too high. Because the Fed inherently, we've talked about this before on the show, the Fed inherently cannot do a good job. It can only mess things up. Ideally, long term, I'd like to see us getting away from a Federal Reserve, certainly short-term, get away from the Federal Reserve setting interest rates.
I have
okay, you got 10 seconds.
I have to rebut this nonsense that spending equals income to vendors and producers. They then turn around, they hire workers, they pay their salaries, they invest in their business. It's a circular flow into the economy.
You've got to last that argument, thank goodness. Well, the subprime has spread into other forms of credit, including auto loans. Will the trend put a dent in car sales? We're going to be talking to the nation's largest retailer of new and used vehicles next on Fox Business. Panel, we reached about the midpoint of what will likely be remembered as a rough week of earnings for the big financials. Will the next earnings seasons be better, or are we in the early innings of our pain? Our Fox panel is back to talk about it. Mike Norman, the one exception to the financials that are doing great is Citi. Is that going to be the lone exception to the rule? Are the others now through the rough pot?
Yeah, even Citi might be a laggard here because there's obviously they had some big write-downs. Even with the write-down of $18 billion, though, it's less than a year's worth of earnings. You don't like to lose any earnings, but still, to put it in context, it's less than a year's worth of earnings. Citi had $200 billion in operating income over the last several years. So, I mean, and by the way, these write-downs, I think people should understand this. It simply is a sort of getting a new guesstimate, if you will, on what the value of these securities are. It does not affect in any way the income derived from these securities. They're still getting that income stream. So it's like if you bought a bond, and in between the time of the purchase of that bond and the maturity, at which time you collect back your principal and all the interest, if it fluctuated down and you said, oh, I have a loss, most people wouldn't look at it that way because they're going to hold on to it.
Nobody at the Wall Street Journal, when I was there, knew numbers better than Elizabeth McDonald. Everybody would flock to Elizabeth McDonald because she analyzes the numbers better than anybody. She is kind of geeky on that point alone. You're beautiful, but you're kind of geeky. So have you looked at these numbers, and is the worst behind us?
No, you look at what you want to look at are the subprime toxic waste that is still sitting on the books at Citi, Merrill, and UBS. $37.3 billion. Sandra and I have talked about it. That's a gross amount. If they net it out with hedging, comes down to 29. Look at UBS, now called the Union Bank of Singapore because of the Singapore cash infusion. $28.9 billion. Another number you want to watch at Merrill Lynch, $21.5 billion. What's happening? Because of capital reserve requirements, banks hoarding cash on the balance sheets. Also, we've got to talk about the shadow banking system, the off-balance stuff that does not have any reserves up against it. Those are the structured investment vehicles, and separate from that, credit default swaps.
What percent of this shadow banking is part of the whole?
You know what? Don't know, and that's a great question. What we do know is that we have a big slug of asset-backed commercial paper coming due in January, north of $450 billion with a B. So can that be turned over?
Yeah.
Don't know.
All right. Well,
Peter the numbers
Schiff,
are still pretty big.
Peter also looks at numbers quite a bit. And Peter, I know you don't buy the government numbers. Do you buy the numbers from the banks?
Well, I think they're real, but I think they're going to get worse. I think this is just a small taste of the losses to come. And, if you go back in time, at one point, Detroit was the automobile capital of the world. We dominated that industry, and we lost it. And I think, unfortunately, the same thing is going to happen to the United States in investment banking and financial services. I think that we have so blown our reputation. Wall Street has basically screwed all their customers, screwed all their shareholders, and, we don't even have the savings anymore to really be the financial center. So I think this is another industry that we're going to lose our dominance in, unfortunately.
You're in. Go ahead.
I think it's going to depend on whether we're going into this deep recession that Peter's forecasting or not. I think a lot of these new CEOs are probably writing down as much as they can right now so they look good in the future as these banks recover. But if we're going to go into much deeper recession, much worse economic times, these banks are going to have a lot more losses to report.
On Joran's point that he made, writing down more than they have to just to make sure everything's out there, it might well end up to be that the valuations are too low, and we see them actually higher at some point.
Hold on, Sandra, go ahead.
I was going to say two big numbers that I keep hearing everybody reiterate today, and it was one that Mike Mayo made when he downgraded J.P. Morgan shares to a hold from a buy and overnight. And two numbers he was looking at: investment banking earnings down 88%. We got out of that report today, and earnings from credit card services fell 15%.
You saw that too at Citigroup and Bank of America and Capital One. But then again, you got to look at the book value. The reason why they're trading on looking like they're on life support is because the assets on the balance sheet have been written down so dramatically, and the amounts that we're talking about are staggering. And by the way, J.P. Morgan, big player in the credit default swaps arena. So that's when corporate defaults start happening. You got to watch out with those exposures as well.
Well, you're on. Do you think that's going to happen? Are we going to have these defaults coming on?
I think there are going to be some defaults, although, again, I think the government is going to bail them out. We still live under a too-big-to-fail strategy by the government. They're not going to let any large financial institution fail. They didn't let Countrywide fail. There's no doubt that the government held it up enough so the Bank of America would buy them.
The government didn't bail out
Countrywide was bankrupt, and they wouldn't let it fail.
You're on. The government didn't bail out Countrywide. Bank of America bought Countrywide.
Yeah, but wait a minute.
Look at how much money Countrywide bought from the U.S. government.
One at a time. You're on. How did the government bail out Countrywide?
By lending them $7 billion from the home loan banks, which are guaranteed by the government. That is the reason
he's absolutely right.
Okay, Elizabeth. Hold on, Elizabeth.
I agree with Joran. Countrywide did turn to the Federal Home Loan Bank of Atlanta and got a massive amount of lending using the mortgages as collateral. By the way, the amount that was drawn down from the state-run bank, bank lending system was $750 billion. That's up from $150 billion in an average year. So Chuck Schumer was right to say
we have something in this country called the FDIC. It happens all the time. Get over it, okay?
Remember, quickly, Peter, go ahead. Peter Schiff.
The element. What causes the government?
Peter Schiff. Hold on, you're on. Peter Schiff.
Remember, the government is incapable of bailing out anybody because they don't have any money. All they can do is print it, which means they socialize the losses among all the holders of U.S. currency. There is no free lunch.
Well, but that's what a bailout. That's what a bailout is.
One at a time. We can't all talk at once. Go ahead, Mike.
I haven't received any notice in my mail of a tax increase to help this fund this bailout, so I don't know what you're talking about.
Inflation is. Inflation's a tax increase.
Inflation, actually, Peter makes a good point. Inflation is a tax increase, and we may be seeing more of that. We're going to be talking about the Fed in just a moment. We got to take a quick break. We got a wild crew here. Look at the market. Very much. Well, also moving markets today, inflation fears, consumer prices rising by 4.1%, reaching their highest level in 17 years. Jumps in gas and food prices led the charge. Those figures complicate the picture for the Federal Reserve Board as it considers whether or not to lower the interest rates to prop up all the sagging markets. Would a cut lead us in a recession by driving up the prices we pay for just about everything? Let's ask our Fox panel, including Nicole Ridgway from smartmoney.com. Nicole, first to you. Analyze these numbers for us. They were bad, biggest jump in 17 years. On the other hand, the market's absorbing it pretty well right now.
The market's absorbing it pretty well, but I think that we can expect the Fed to probably cut rates. I think that that's generally accepted, and I think it's already been worked into the market.
Even with these inflation fears?
Even with the inflation fears, because I think that the Fed's attention right now is turned towards slowing growth and sort of stimulating the economy. That's where a lot of attention has been paid recently. Cuts alone, though, I don't think are going to fix the situation and could definitely worsen the inflation side of this argument.
Well, Peter Schiff, you've been talking about the debasing of the American dollar for a long time, and frankly, a lot of what you said has turned out to be true. However, I'm wondering, how do you stop the debasement of the dollar? Do you just do what Volcker did in 1981 and tighten up so much that you have a 2-year-long recession?
Well, I mean, we've got to do that. But unfortunately, when Paul Volcker raised interest rates up to 20% in 1980, America was a wealthy enough nation that we can afford to pay it. Plus, also, most of our debt, we had 30-year government bonds. Now we have almost a $10 trillion debt financed with Treasury bills. So if we actually had to raise interest rates to defend the dollar, we would have a far worse recession than what we had in 1982.
So let me just get a figure, though, from you, Peter. What rate, if they were not high enough in 1981 at 20% for what we have now, what rate would they have to be risen to in order to stifle inflation?
Unfortunately, I don't think there's a rate high enough at this point. Well, because if we raise the rates, I think it's going to put even more downward pressure on the dollar.
So what do we do, Peter? That's the question.
What we've got to do is we've got to dismantle the government. We're spending way too much money. We've got to make the government smaller. We've got to stop printing all this money. We've got to get on a sound monetary system. You're talking about the consumer prices rising at the fastest pace in 18 years, but those official estimates are probably less than half of what's actually happening to consumer prices. Yeah. And they're going to go up even faster. So we've got to turn this around.
Let me switch to your friend, Yaron. Yaron, I know you agree with Peter's prescription, but you have to be a realist. It ain't going to happen. We're not going to have a total dismantlement of the government. So within the realm of reality, what can we do?
Well, we don't need to dismantle the government tomorrow, but we need to start. We need to start cutting government spending. We need to start dismantling the regulatory state. We need to start taking those measures that long-term are going to secure this economy and start us producing wealth again. Cutting interest rates is just going to fuel inflation. Sending checks to people is going to fuel inflation. It's going to do nothing long term. We need to get back to what the U.S. government was supposed to do, that the Founding Fathers wanted to do, and that's protect individual rights, not spend on all these multiple programs, redistribute wealth, get into every aspect of our lives. We need government to back out.
Well, I think everybody, even Mike Norman, you would say amen to that as well, but the problem is we have to talk about what is capable, what we are capable of doing.
Look, the government is no bigger now. In fact, it is smaller now as a percentage of... Hey, Peter, can I speak here? The government is smaller now than just about any time in the post-World War II history when you look at the government at its budget as a percentage of GDP. Let's put things into context here. In terms of regulation, we are the least regulated country on the face of the earth. In terms of wealth creation, there is no other country, and there has never been a country in the history of the world that has created so much wealth as the United States, and it continues to be the case. Yaron, you said something earlier about, we're losing business because of Sarbanes-Oxley. Sarbanes-Oxley has been a benefit because it has made companies become more transparent. Wait a second, Yaron. Many companies themselves are thankful of Sarbanes-Oxley because it has forced them to look within their own operations and see what exactly their accounting is like before they did not know.
Yaron, go ahead.
I mean, that's completely ridiculous. If you talk to CEOs, if you talk to businessmen, what they tell you is that the cost of their companies, this has cost tens and hundreds of millions of dollars to American businesses. The net cost to the U.S. economy is at least $1.5 trillion by conservative estimates. This has been one of the most wealth-destroying pieces of legislation in the last 40 years. And going to the percentage of GDP, absolutely. Since the 1950s,
unadulterated
government keeps... That's nonsense, Mike. Talk to these guys, run the numbers,
nonsense. I don't
get
know,
educated.
One of the reasons capital...
Hold on. Let me just ask Nicole if she could break this tie. Can you? We've got a rubber match here. Break the tie for us. Was Sarbanes-Oxley good or bad for the economy?
I think it's good. I think that we set an example to world markets, to other countries.
So now, and Peter Schiff, I know you agree with Yaron. So now we have another bumper.
Right. Look, you know, Mike, you can still recognize that we have a problem. You're trying to make this into a thing of patriotism, talking about how great everything is.
Are you telling? You try to turn it into how bad everything is. I deal in facts. You deal in fantasy.
Hold on. Get to your point. Hold on, gang. Without the birdseed gang, Peter, get to your point, please. Okay, go ahead.
Mike he's got to unwrap the flag from around his face so he can see reality.
The birdseed, get to your point, Peter.
America was a great country when we produced and when we saved, when we had low taxes and low regulation. That country doesn't exist anymore. I'd like to get it back, but I'm not going to pretend that everything is okay just so it sounds good and I can pretend to be a patriot.
But at the same time, Peter, what you got to admit is what we have going for us. We do have extraordinary workers in the United States. We have, by the way, more people. Hold on. Excuse me. Let me just say one thing. We have more people trying to get into this country, dying to get, literally, to get into this country than any other country in the world.
What made America so great was not that Americans were better than anybody else.
All right.
Hold on. What made our country great was because we had
hold on. We got to take a break. We're up
freedom.
against a hard one here. Some good. So has gold lost its glitter for investors? This after a bull run up to $900 an ounce. Today it was down $17 an ounce. It's still pretty healthy at $885, but again off of that $900 mark and pretty far off of that $1,000 mark. Should you buy on this dip, or are gold's best days behind it? Mike Norman and Peter Schiff are back now to debate it. Mike, first to you. Lost its glitter, gold?
It never had any glitter. It never had any glitter. Look, if an investor bought gold in 1980 at the last time when we had this big cycle in inflation, that investment adjusted for inflation right now would be down almost 60%. In other words, you would not have recovered your money. By the same token, stocks, the Dow Jones Industrial Average adjusted for inflation is up almost 600%.
Okay, I'm watching the time. I'm going to give you each about the same amount of time. Go ahead. I may stop you, Peter. Go ahead.
Let me go. Well, first of all, 1980 represented the end of the bull market. The bull market began in 1970 when gold was at $35 an ounce. And back then, the Dow was worth 20 ounces of gold in 1970. Right now, the Dow is worth 14 ounces of gold. So if you bought gold when it was cheap, you did better than the Dow.
Okay, hold on. Back to Mike now. Go ahead,
Peter,
Mike.
do you know why gold was worth $35 an ounce in 1970? Because it was pegged there. It wasn't allowed to trade freely. And then when it was allowed to trade freely, there was a time that it caught up. It's like if you have wage and price controls. Peter, if you took the time...
Hold on. Each go. You've got another 5 seconds.
If you took the time from 1973, where gold started to trade into the hundreds until now, guess what, Peter? It's still returned less than stocks.
Peter, go ahead. Is it a good buy now?
Yeah, look, give you a little background. Back in 1999 and 2000, Mike and I were both bulls on gold when gold was under 300. We didn't have a lot of company. A couple of years later, when gold got to about 400 to 500, somewhere in there, Mike Norman turned bearish. He's been bearish ever since. I've been bullish. We'll see what happens. He made a little money in the beginning. He's left a lot on the table. I think gold's going a lot higher, and I'm sticking with
Mike,
it. And it glitters for me.
Go ahead.
Are you saying in the last 2 years...
Don't ask questions. Just make your point.
Look, you could have bought Google and seen it going up 10 times in value. You could have bought Apple in 2006 and seen it go up 5 times in value. You could have bought Research in Motion and seen it go up multiple times more than gold. Peter, let's face it. Gold is a bad investment. It's even a bad inflation hedge.
No, it's
not even an investment. It's a speculation, and that's it.
Peter, go ahead.
Gold is outperforming other asset classes. You can find individual stocks. Sure, you could have bought Xinjiang gold mining in China, and that's outperformed every single stock that you mentioned. I'm not talking about speculative gold stocks. I'm talking about an asset class. And gold is outperforming stocks as an asset class. It will continue to do that probably for another 5 or 10 years.
Mike,
so you can be oblivious to that, but I'm going to profit from it.
In the last 2 years, yes, it's outperforming the averages, but if you want to do this, we could go back and forth all day. I just gave you several examples of stocks that would have trounced gold.
Those are stocks. I can give you all kinds of gold stocks that did better than those.
Peter, let's look at gold over a long history, my friend, and I could tell you this, and the data absolutely supports this, that gold has been a terrible, terrible investment.
Let me ask one question. One question of Mike Norman,
and when you sell it.
Peter, hold on. One question. Yeah. Why did you turn bearish on gold when it was at 400?
Because I felt it became very speculative, and yes, I got out way too soon. And sometimes, look, Warren Buffett, he bought what is it, China Petro PetroChina, and he said it was a market cap of $30 billion, and he got out when it went to $120 billion, and guess what? It went to $300 billion. That's Warren Buffett. I don't profess to even be anywhere near as smart.
And Peter, I got to tell you, I had a Krugerrand that I bought at $300, which was I knew it wasn't going to get much cheaper than that. I sold it at $600. I could have made a couple of $100 more, but I feel pretty happy about a doubling of my income, shouldn't I?
Well, it depends on, what happened to consumer prices. A lot of people think they're making money if they have more dollars, but the dollars might have a lot less value. Gold is a good asset to own at certain periods of time. Gold was great to own in the 1970s because of the inflation we created in the 1960s, and gold was great to have owned in the 1930s. It's going to be great to own gold for many, many more years. But you're right, Mike, I'm not going to keep my gold forever. At some point, I'm going to buy up assets when they're very cheap, and I'm going to get good dividends on very low-priced U.S. stocks.
Mike,
but right now,
I can say, look, you could go back to 1929 until now. The stock market has returned about 6.5% compounded annually.
But
gold has returned about 4.5% compounded annually. Peter, gold pays you nothing. Wait a second, Peter. Gold pays you nothing. There are no dividends. It pays no interest whatsoever. It's a pure speculation. To buy it at $250 was a prudent thing for me because it was below the cost of production. Now it is a wild speculation, and people are going to get burned. I can assure you.
In 1929, the Dow was worth 20 ounces of gold. It's worth only 14 today. It's gone down.
Because gold was at a fixed price, Peter. You don't understand. If it wasn't at a real price,
we were on a gold standard. Gold was money.
But if it
gold
wasn't
was the same price for over 100 years.
If it wasn't at a fixed price, it might only have been, 4 ounces to the Dow, and then it would be now 6.
Mike, you got to wake up to reality.
No, the reality is you can't make that analysis when gold was held down artificially in price.
No, it wasn't held down by anybody. We just didn't have a central bank printing a bunch of money.
But you had the government that said you could only exchange dollars at a rate of $32 per ounce of gold. That was a fixed price. It wasn't allowed to appreciate.
No prices were going up. We didn't have any inflation back then.
If you keep a commodity artificially low because of some kind of constraint or wage or price control, and then you allow it to float, it's going to reach a new equilibrium
I agree,
level.
Mike. That happened during the 1960s.
And you can't go back to that time when it was held down.
Hold on, he's agreeing with you. Go ahead, Peter, on the 1960s.
Look, that's true in the 1960s because we ran these big deficits. We created a lot of inflation while we were still on the gold standard. That's why we had to close the gold window and go off the gold standard because of the irresponsible monetary policies of the Federal Reserve during the 1960s.
All right, guys, we started with Mike. We're going to end with Peter. That was about the most instructive discussion of gold I've ever heard from either one of you. So thank you very much.
You're welcome.
Peter and Mike. Well, U.S. banks... Well, as our giant financial institutions struggle with huge write-downs, countries like Japan, Singapore, Saudi Arabia, Kuwait, well, some of them have come to the rescue. But is this kind of foreign investment good for America? Earlier, Dagan McDowell spoke with presidential hopeful Hillary Clinton about just that.
More than $30 billion has gone into Citigroup and Merrill Lynch. We're hearing from people on the street. It could be hundreds of billions of dollars more from foreign investors, foreign companies. And I wanted to know, would you stand in the way or oppose an investment or a bailout in a Wall Street firm or bank by Middle Eastern, Asian, or Chinese investors or the Chinese government?
No, I understand the urgency of this and, have the greatest respect for the leadership of a lot of those institutions in the city and state I represent trying to figure out what to do going forward. But I am concerned about these sovereign wealth funds, and I think we need some rules. We need some transparency. We need them not only here in our country, but internationally.
So what does our panel think about all this? Let's take it to the panel. Nicole Ridgway, the clear answer that Hillary Clinton said was no. Now, she has a lot of influence among Democrats. She may be the next president of the United States. So if she says she doesn't have any problem with these sovereign funds coming in, I guess that's it, at least from the Democratic side, right?
Yeah, I mean, I don't really have much problem with the sovereign wealth funds either. I feel that, once they take in more of like a 10% or more stake, that's when they start getting looked at by the U.S. government.
Because then they could actually influence the policy of the bank.
Right, exactly. So that's when the government starts looking into it. Most of these sovereign wealth funds don't even want to deal with that. So they could put their money, they could, spread their bets a little bit if they wanted to, a smaller percentage stake.
Although, we did have that prince who had invested in Citi taking a late-night meeting with Sandy Weil, that after which Mr. Prince, not the Prince, but Mr. Prince, the chairman, was out the door. So maybe they can have influence with less than 10%.
Yeah, but I don't have any problem with them having
Really?
influence. Let them take more than 10%. Absolutely. I mean, if they run the business well, shareholders will benefit. If they run the business poorly, they themselves will suffer. So what's the problem? American shareholders are selling them shares. It's a shareholder issue. The real problem is the fact that American banks need this capital. That's the real concern, is the state of our financial institutions, not where they're getting the capital from.
Well, but let's stick on where for a second, Peter. Do you have any problems with the fact that these are not funds of private individual. These are funds put together by foreign governments. Is it a problem if a foreign government has a lot of influence on our banking institutions?
It's a big problem that when American companies need capital, we have to go abroad for it because we squandered our own on consumption. You know, we borrowed all this money. We bought consumer goods. Our creditors loaded up on our IOUs, and now they're cashing them in and taking our assets. And what this means is going forward, we're going to have to make large dividend payments to foreign owners of these assets. That's going to exacerbate our current account deficit and lead to a falling standard of living for Americans.
I want to keep focus here. Do you have a problem with foreign governments having influence on U.S. banks because of their investments?
Not at all. They're under a regulatory structure that any other domestic investor would have here.
But so was a bank controlled by BCCI that turned out to be one of the most corrupt banks in the world. That was a problem back in 1991. Could something like that happen again?
No, I don't think so. And this is all part of the free flow of capital.
But there are plenty of corrupt banks run by Americans.
Well, difference you're on between a bank like BCCI, which did infect our banking system once it got involved, and it was involved in a lot of drug dealing, it was involved in funding terrorism and everything, and its books were not transparent. Our books have to be certain amount of it have to be transparent anyway.
They're only not transparent because there was no enforcement of the laws. But look, we have regulations in place regarding transparency, way too many regulations, in my view. But, you know, we have Canadian banks in the United States. We have Scottish banks in the United States.
But,
I mean, I don't see, and capital flows globally. It flows out of the U.S. It flows into
What difference does
it make who owns the capital to the shareholders of Citibank?
We're sharecroppers in our own
country.
Ahead, Peter. We're selling off our cows to buy milk. This is a nation in decline. If we really had a growing economy, we Americans would be buying up foreign assets. We would be taking our appreciated dollars.
But you're not suggesting we stop this investment, are you?
I didn't hear the question. You're on. Ask the question again. Go ahead.
You're not suggesting we stop the investment as a consequence. You're saying it's a symptom of something bad going on in the U.S.
Yes, I'm not saying
Peter, go ahead.
I'm not saying we should stop it from happening. It's very unfortunate that it's happening. You know, it's a symptom of our declining industrial might, our declining wealth and standard of living, and we need to turn this around. We need to go back to our roots. You know, you said earlier that we've got the greatest workers in the world. That's not why America was successful. Our workers are the same as workers everywhere else. What separated us from the rest of the world was our Constitution, our limited government, our laissez-faire.
So Peter, answer this question.
We need to go back to that.
Peter, I've heard that from you so often, but answer the question. Why is it that millions and millions of people, not just Mexicans, but people from Cuba, people from China, people from all over the world are dying to come to the United States?
There are a lot of people coming here. We have a huge social welfare state. There are a lot of people coming here to get on the
social welfare state of Europe.
I don't think that people are not coming here the way they did in the 1900, 1910, 1920, like my grandparents. They're not coming here to work. They're coming here to get on the California,
move to Texas.
Exactly. Look,
the U.S. is still one of the best countries in the world to live in spite of Peter's pessimism. It's one of the greatest countries in the world still. When you travel around the world, people want to come here because we're freer. But we could be a lot better than we are, and we can do that by going back to the roots that Peter talked about.
Go ahead.
We can do that by going back to what this country was founded on.
The very thing that these two guys fear would occur precisely if we become a closed nation and stop these capital flows.
Who's advocating that?
And nobody's
exactly what
that.
would happen. We should not be fearful of these things. We should allow these things. And another thing,
let me play the other side of that. Nicole, what about the fear that you have a banking institution that is not as transparent as ours, even though ours have problems, that comes into our banking system and that kind of infects it the way that BCCI did back about 15 years ago? Is that a problem now?
I don't see it as a massive concern, really. No? I think we have the regulatory structure right now to kind of catch those things before they do infect the system. I'm not saying it's foolproof, but I am saying that I think that we're much more aware of what to look out
And
for.
Mike, one of the questions that Hillary Clinton was asked was, look, you had a lot of problems with Dubai and the ports, that deal that was squashed by members of Congress. Why don't you have a problem with the idea of banking institutions coming in and taking over our banks from foreign governments?
Dubai was more of a security issue. They were looking at Dubai running the ports where you have sensitive, it became more of a security issue. At least that's how it was treated in Washington, and I think that's why that deal went down. I think, look, and Euron points it out, we've had Canadian companies, we've had many different companies that invest here. The United States has been doing that for a long time, in the opposite sense.
Yeah. So, Euron, is there no security concern with finances getting in control of the wrong people?
No, because what does that mean that finances get controlled? If you
well, you know that money laundering is the Achilles.
Competitors will
hold on, money laundering has been described as the Achilles heel of the terrorists. So it does play an important part in what the terrorists do and drug dealers.
Sure, but you put national security aside. If national security is an issue, let's address national security. And the way to deal with terrorism is not by not allowing foreigners to invest in our banks. There are other ways to deal with terrorism.
Okay.
But
Last word goes
issue.
to Euron. We got to leave it at that. Thank you, gang. Let's check in the markets before we go to a break. Just a few minutes now until the end of the close of the trading day. The Dow is now down about 12 points. Again, you blink your eyes and it's down or up. It's moving all over the place today. And for more details of what's happening with those wild traders, let's go down to Wild Tracy Burns. She's on the floor of the New York Stock Exchange. What is going on, Tracy? It can't make up its mind. Can you hear us? No, I guess she can't. All right, Tracy is writing down furiously what is going on. As soon as our producers let her know that she's on the air, we'll go to her. But meantime, let's go to Nicole Ridgway. What is going on with the market? We see volume at a pretty healthy pace. It's 1.876 billion trades so far today. So what is happening? The market's really trying to find itself.
Well, there's a lot of factors at play here. You had Intel's earnings, which, the earnings themselves weren't bad. They kind of gave an outlook that wasn't as bright as everyone had hoped, but they really knocked Intel down. There was a real gut reaction to that stock this morning. And then you had the CPI data, which basically had a lot of people thinking that maybe there is going to be another interest rate cut. So there was a lot of things at play in the market today.
Mike, let's talk Intel for a second, because it is a very well-run company. Everybody in Silicon Valley that looks at it say it's a good company, well-run. It doesn't have a lot of competition from abroad. Its product base is broad and distributed, but they had that big negative sign yesterday of not meeting the estimate of the experts.
It wasn't only not meeting the estimates, but it was the forward outlook looking a little softer than the street thought. But look, Intel at these levels is a tremendous opportunity. I own the stock. I bought it here a year and a half ago at $17 a share. Went up to 27. Back down here, I'd buy it again. They dominate in their field. They're the most innovative. Their chips are in everything. And right now, at this price level, their competitor is under a lot of stress, AMD. It wasn't like that the last time around. So, I mean, look, David, there are many opportunities here. So many stocks, especially ones in financials, are trading as if they're facing a binary event, whether to stay in business or go out of business. And frankly, that is an enormous, I've been on Wall Street almost 30 years, an enormous overreaction.
Well, Tracy is back in touch with us, I understand. Tracy, what is going on? We're trying to explain what the identity crisis of the market is right now. Where is it going?
You know what? It's a return to the fact that we still don't know what's going on. We had 2 different days today. We had a morning that was with negative news. We had an afternoon with some good news. And at the end, it's going to end up flat. This is short covering, clearly. People are still concerned. Mike Norman was just saying that there's opportunities in the market. It's interesting that the sectors that are typically down, financials and the home builders, were up today. So does this mean that we're signaling some sort of potential light at the end of the tunnel? It's possible. So between that, the short covering, energy stocks down, commodity stocks down, you have people taking money off the table because they're nervous about what's going to happen. I still think there's uncertainty, but it's not all bad. I think that we're starting to feel that the end is close. Merrill's going to be very telling tomorrow. John Thane has background in these risky securities. That's where he comes from. Everyone is really looking to Merrill to come clean, take a big write-off, tell us what's going on, tell us what the future looks like. And I actually think that could really make a difference with the market going forward.
You're on. Do you think it could make a difference?
Well, I think you're facing here multiple levels of uncertainty. You've got the highest inflation in 17 years, heading into a recession, and you've got a political campaign, stimulus packages being thrown around. You've got enormous amounts of uncertainty, and that's what you're seeing. You're seeing it intraday, and you're seeing it across days. And until we get some insight into where this economy is heading, this volatility is going to continue.
Peter, I want to ask you, politically speaking now, really in a practical, inside-the-beltway manner, do you think any of these stimulus packages have a chance of surviving the coming recession? If you spend money, if you lower tax rates as a recession is coming, you're doing more damage to the economy. So will they pass?
Well, I don't know. I mean, they might pass something, unfortunately, but it's not going to help the economy. I mean, they might think it helps their chances of getting reelected, but I mean, that's how we got into this mess. But, getting back to the markets, we might get a little bit of a bounce here. I wouldn't be surprised after the precipitous drop, but, we're going to have another leg down. Mike Norman threw out some names of some tech stocks that did very well over the past few years, but there are a number of stocks that are down 50%, 70%, 90%. There are a lot of stocks that are going to go bankrupt in this environment.
Well, but that's what happens in a capitalist economy, isn't it?
That went up 50%, 90%, 100%. And Peter, there's stocks.
Hold on, Peter. Go ahead, Mike. Hold on, Peter. Go ahead, Mike.
What happened to my spot?
Go ahead, Mike. Go ahead, Mike.
There are stocks that went up 50%, 90%, 100%. In addition to the ones I mentioned, okay?
I know, but there's a lot. Look, there's a lot of pitfalls and landmines here. And yeah, sure, the best performing stocks have been gold stocks and oil stocks. Look around the world; some of these stocks are up 50 times.
David.
The problem is...
Hold on, Peter. Hold on. Mike, go ahead.
I have to chuckle because they talk about there's so much uncertainty. When is there certainty? The old saying, death and taxes, okay? When everything was great, when we were 14,000...
I don't think there's uncertain things are going to get worse.
Hold on,
I'm not certain about that.
When we were up at 14,000 and everybody was saying wonderful, well, guess what? We look back now, it wasn't wonderful. And that's why I'm a contrarian and I say, look, things look bleak and horrible. Now we have the worst level of sentiment right now in 17 years.
You were very bullish at the top.
Hold on, gang. Nicole, excuse me, gentlemen. I'm asking the lady a question. Nicole, real estate has gone up 70% in the past 3-4 years. Huge rise. So if it comes down, it has to come down 70% to reach the level that it was only 3 years ago. So we got to put things in perspective, right?
Right. I mean, we had a huge run-up in several areas. And, yes, real estate is expected to continue to go down. And that puts a lot of people in a bind who bought during the boom years, But...
it also puts people in a bind who borrowed during the boom years. A lot of people who bought their houses 5 or 10 years ago now have so much debt that their houses now have negative equity.
We've only seen a 6% decline in home prices so far through October. According to the Case-Shiller Index, you'd have to see about a 20 to 30% decline to put a massive number of Americans in trouble in terms of negative home equity. So you're wrong. Your numbers are wrong.
Mark my words. You will see it.
All right. Well,
okay.
Mark his words.
We will mark the words. We're cutting the tape as we speak, Peter. Thank you very much. The closing bell just around.